Hello everyone, it's Chuck Corneville, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the co-founders of the Dividend Kings marketplace service on Seeking Alpha. For starters, I hope all of you are staying safe, and although we're all suffering, I'm sure that we're all getting through this horrible coronavirus crisis that we're facing and the economic impact it has brought us. I hope our families and all of you are safe and healthy as we go through this. But from an investment perspective, the virus has, and the economic hardship that's come with it, have really done a couple of things that I think are kind of important and possibly even beneficial, if you can even say such a thing about something as horrible as what we've been going through here. But one thing that's happened is market prices of many stocks have been very, very high. We've had this long-running bull market. And with a long-running bull market like that, we tend to get some complacency, and I'll be addressing that just slightly in this video here. But as the crisis has come, we found this is really a black swan, something that was, unexpected and certainly unprecedented in my lifetime. I've been doing this for 50 years, and I've never seen anything quite like what we're unfortunately all going through worldwide with this pandemic here. But having said that, it has kind of cleansed the market a little bit, if you will. And so what I want to try to demonstrate here and help reiterate, because I've said this often for those of you who followed my work, that it's a market of stocks and not a stock market. And what I'm going to suggest is that, not all stocks are the same. And anytime you're making investment decisions, you should also always be making them one stock at a time. I believe in building portfolios one stock at a time, and not so much about where the market is, but valuation is on the individual stock that you're actually examining. So I'm going to also then point out that during a crisis like this, safety and quality are kind of go hand in hand, and it's probably never been a more important time to be worrying about the safety of your investments. But safety is a multifaceted concept. The first thing we're going to look at here, I'm going to look at two companies that from a standpoint of fiscal health, financial health, if you will, balance sheet strength, earnings histories, and business opportunities going forward are two of the most impeccably safe companies you can just about identify in the entire marketplace. I'm going to start out with Honeywell International here, an industrial conglomerate. The company's A-rated, has 33% debt. As you can see, a very good balance sheet. So, we're looking at a company that the business itself is very safe. I want you to notice this orange line plots the company's earnings growth. They occasionally have a down year of earnings, but they've stayed profitable throughout this entire time. Their dividend record has been extremely good. That's the white line here. This green shaded area is profits. The area below the white line would be the portion of earnings that the company pays out in dividends, which I've also then simultaneously reflect by stacking the dividends after they're paid out on top of the orange line here. But what I also want to add now is market price. This is the business results of the business. Now, if I add monthly closing stock prices to the graph, you can see that there is this general tendency in the long run of stock price to go where the company's earnings go. Now, there will be times when it disconnects, when the price is above what earnings would justify, and times when you'll see the stock when prices are below what the earnings would justify. And of course, we had a big drop here during the Great Recession. We did have also a drop in earnings, but I do want you to notice that Honeywell raised their dividend from 2008 to 2009. They did freeze it 1 year in 2010, but they did not cut it. They maintained it. And then the dividend has grown every year since. So if I look at it going back over this entire time frame, the average dividend growth has been about 8.6%, and the compound average growth about 8.5%. So really, we'll call it 8.5% dividend growth. Now, the orange line is a PE ratio of 15. So anywhere I'm looking at this orange line, I'm seeing a PE of 15. And I can use that as a valuation reference and then try to determine, when the most appropriate or opportune times to invest in a stock like Honeywell would be. Now, I don't really want to be buying it when the price is way above the orange line. I clearly want to be buying it more optimally when the price is below the orange line. But I'm going to add another valuation reference line to this graph, and that's what we call the normal PE ratio, which is actually a trimmed average. We throw out a high and a low, and what we do is it's kind of a best fit line, if you will. It's drawn here. It's designed to help you understand how the market has most commonly valued a stock over whatever time frame you're looking at. But I do want you to notice that the blue line tends to be more dynamic than the orange line. So for example, here I'm drawing orange line at a PE of 15 and and the blue line at a PE ratio of 16.5. So anywhere the price touches the blue line is trading at 16. But this allows you to mentally look at this and say, how's the market, traditionally valued the stock? Now, if I shorten the time frame on this graph, I want you to notice that the orange line still stays at a 15 because that's generated by a formula that's attempting to determine what would be a intrinsic value for a company with these characteristics. And the blue line is the market value, how the market's been valuing it. But those lines can both be dynamic, but the blue line more dynamic than the orange line. And these are monthly closing stock prices. What I want you to notice here is that whether I'm using the blue line or the orange line, Honeywell for most of the last couple of years, 3 years at least, was actually very, very highly valued by the market, overvalued. Now, during the crisis here, the stock had fallen dramatically, from a high of around 178 in November of 2019. And let me see if I can hit this here, down to, through yesterday's closing price, down to 132. That's about a 26% drop in value over that relatively short period of time. So it did have a big drop, but I do want you to notice that it's only come down to the 16.5 PE ratio. It has not fallen below the orange line, if you will. Now, I also talked about forecasting being the key. So let's go ahead and look at forecasting here and talk a little bit about what expectations are. Honeywell is expected to have a negative year, and this forecast is pretty current now. It's in spite of the coronavirus. The company's expected to have a slight downward period of earnings, and I'm using the 15 PE here. And one of the things that I always stress is that I never make an investment without running the numbers through to their logical conclusion. And I typically like to try to draw a best case, worst case, and maybe expected case situation. Now, my expected case here would be that the stock goes back to the orange line, like if we look at it historically, like it has done many, many times over the years here. It's gone back to the 15 PE, which is actually where I believe it belongs. So, and I don't like to go out more than a couple of years. I can go all the way out to 2022 here, and I would expect about a 4.34% rate of return. If I went out to 2021, my rate of return would drop down to less than 1%. That's simply because the stock price is above the theoretical valuation line. Now, if I use the market's more generous 15 or 16 PE, now this is defaulting to a 17.9, which is skewed because that's been what it's been for the last 5 years. If you recall, it was been overvalued for the last 7 years. If I go back to that more normal 16.5 type PE, which we saw, then my rates of return would get a little better, be about 5.3% out to 2021. So I would call this perhaps a best case type scenario. And if I go all the way out to 2022, I can make 7 or 8% rate of return. My expected case, of course, was a lot lower. And then I could always, just point to these are different PE ratio lines on the graph. If it fell down to, if I look at it historically and say, what's been the normal PE ratio, I can use this drop down here and I can see historically it's held up at that 16 PE. But if I go to the historical graph, I can also see times where it got down to 11. And of course, in the throes of the Great Recession, the PE actually got down to 7. So if I'm using the forecasting graph and I go down to I'll use the lowest I can go here that I have, which would be an 8 PE, then I could actually have a negative rate of return. But that's probably not a realistic assessment. My point is I could make 6 or 7% a year. So here's a case where quality to me isn't enough. I've got an impeccable balance sheet, A-rated, moderately low debt, but I had such an overvalued stock here, and even after having a significant drop, I don't see the opportunity to make a great deal of money. Now, I want to contrast that by looking at another impeccable quality stock, one of the major Canadian banks, the Bank of Montreal. And there's some different aspects here. I'm kind of going through how you would use a tool like Fast Graphs to analyze common stocks. And here what I see, I still have that orange line, and I'm still drawing it at a 15 PE ratio because I've got a similar 5-ish% growth rate. A slight difference in forecast. We are expecting a negative year this year and not a whole lot going on for the next couple of years. But the difference here is that, like a lot of financials, the market's been valuing this at a discount to that orange line. The blue line here, which is about a 12-ish PE, 11.8 is the actual number, but that's that's 11 to 12, we'll call it. I can see that by looking at the graph here that 11.8 PE has been a pretty good norm, and if I could buy it at PEs less than that, like here's 9 PE, like it is now, it's trading at a 7.4 PE, then these would be more opportunistic times to buy the stock than buying it even if the PE got up here to 13 or 14, and the one time it did get up to over 15. But the point I'm trying to make here is I still have the price kind of tracking earnings of the company. It's just doing it at a different valuation level. But here, this stock was actually undervalued as it came into this crisis that we are now experiencing right now. And then if I price it through yesterday's close, it dropped 33% also, which is a significant drop. But the difference here is it has now fallen into significantly undervalued territory, even though forecast growth is considered to be relatively benign or low over the next couple of years. But here's a case where valuation really plays a game. If this goes back to a normal PE in the 11 to 12 range, this particular one that I'm using is 11.39, over the next 2 years, you could be averaging over 35%, almost 38% a year annualized out there. And if I go all the way out to 2022 in this example, I don't have quite as much forecasting data as I had on Honeywell, I'd still be making over 22%. And that's with very little growth. We're only talking here about a growth rate, if you will, that's negative 2.01%. But what's making up for that is the incredible low valuation that the company is currently trading at. And so, as I'm looking here, I'm running my numbers. My best case scenario could possibly be, the company going to a 15 PE, and that would give me a very attractive rate of return out here. Although looking at the long-term history, I don't consider that to be very practical. There's only been really a couple of occasions where it even got close to that. So I'm going to sit here and, say I'm going to look more at that 11 or 12 PE. And once again, I can draw the PE that I like here. And this 11.39 PE is about normal for what the company's traded at over the last several years, going all the way back to about 19 years. So I'm going to leave it and say this is kind of my expected case. This is what I would expect the company's valuation to go to. It was only just a few months ago that it was actually trading at that 11 or 12 PE, if you will. And even though I've got no growth here, I've got a great opportunity. So the point is that not all price drops are the same. Honeywell fell from being overly valued, and I still consider it overvalued even today. Now, it's not as bad as it was a few months ago, but even though I consider that an impeccable company, I don't like the valuation, where Bank of Montreal, with even a more impeccable balance sheet, A+ rated with only 6% debt, and kind of weak growth prospects going forward, I can still have an opportunity to make a great deal of money if the market normalizes over the next couple of years and the PE, the earnings, first of all, hold up as currently forecast. And this is considering the COVID crisis, by the way, in these forecasts currently. That could subject to change, obviously, and I'll be monitoring that because that's very important that you watch that. But as it sits right now, if I get back up to an 11 or 12 PE, I can make a great deal of money in Bank of Montreal, and I've got safety in a double whammy, if you will. I've got extremely high quality company, but I've also got a significantly low valuation, which is where the opportunity comes from. Anyway, this has been Chuck Harva. I hope you enjoyed this video. If you like what you see here, please subscribe to my YouTube channel. And if you're looking for good dividend growth ideas and dividend income ideas, you also might want to take a look at our Dividend Kings marketplace service on the financial site Seeking Alpha. Thanks for watching, and everybody stay safe, and I'll look forward to talking to you the next time.